Bom dia a todos. O webinar de hoje será feito em inglês, já que teremos a presença do economista Tom Orlik, do grupo Bloomberg. Good morning to everybody, and welcome to the webinar by the Brazil-China Business Council. We are today having a debate between Tom Orlik, the author of a book, The Bubble, China, the Bubble That Never Pops, and Marcos Caramuru, a former ambassador of Brazil to China. This book by Tom Orlik is quite an extraordinary one because it examines a number of predictions which have never become true. Throughout the several years, more than 10 years, people used to say that the Chinese economy appears destined for failure. The financial bubble is in peril of popping. Real estate sector is doomed to collapse. Factories are fated to bankruptcy. And banks are drowning in bad loans. Well, this, since I'm dealing with China since 2004, has been a constant opinion on various economists, politicians, journalists, but it never comes, this popping of the Chinese bubble. The popping of Chinese bubble is always coming, but never arriving. So therefore, we are in a very privileged situation to be able to have Tom Orlik with us here, and also Marcos Caramuru, who has an extraordinary experience in China. He lives in Shanghai, and has been a Brazilian ambassador to China, and before that, Consul General of Brazil in Shanghai. So I won't take much of your time, and I will pass the floor to Tom and Marcos for their presentations. Tom, you have the floor.
No, I think I have to start.
Oh, you have. Yes.
Yeah, because I have to give the rules of procedure. But okay. First of all, I want to say good morning, everyone. Good morning, Tom. Good morning, Luis Augusto. I, first of all, would like to congratulate the CEBC, the Brazilian-China Business Council, for organizing this webinar. I read Tom Orlik's book, China, the Bubble That Never Pops, and I found it one of the most interesting books about China that I've read it recently. Tom provides really a clear description of all the stages the Chinese economy went through since the opening of by Deng Xiaoping, and the challenges that the economy faced, the way that the economy had to deal with different international crises, like the Asian crisis in the 90s, the Lehman Brothers crisis in 2008, and so on, and it's with its own problems, like the 2015 problem in the equity market, in the stock market in China. And he provides a very clever view of how China dealt with these problems. His analysis is sharp. The economics of the book is very dense. The book is academically impeccable. All those who want to have a reference of other books about China can follow Tom's suggestions and Tom's the number of books that he lists in his own book. So it's pleasant to read. It's dense. It's substantive. I want to congratulate CEBC and congratulate Tom about that. Just 2 or 3 days ago, Financial Times published a very interesting review about this book. Much after Claudia called me and said that CEBC was planning to have this webinar today. So in a way, CEBC anticipated the international repercussion of this excellent book. Let me give you the rules of procedure for this morning. We are going to have Tom speaking for 20 minutes, presenting his book and his ideas about China. Then in the next 20 minutes, I'll have an interaction with Tom. I'll make a few comments and a few questions. And then the question and answers section is going to be open for the public, for the audience. You have to write down your questions using the Q&A window in Zoom. We are going to receive the questions little by little, and then we are going to present them to Tom with time. Thank you very much. And Tom, the floor is yours.
Well, thank you very much, Ambassador Caramuru, and also thank you very much to Ambassador Castro Neves for the generous introduction, and to Claudia and the team at the CEBC for putting this event together. It's really a great pleasure to be here and to share some of the main findings from my book. Now let me share my screen so you can see my presentation. Now, is that working? Can you see my slides?
Yes.
Great. Okay. So I lived in China for 11 years, from 2007 to 2018. And for that entire period, there was a consistent tone of pessimism, even a thread of doom running through the Western commentary and analysis on China. Yes, the story went, 10% growth looks very impressive, but if you poke beneath the surface, it's a bubble. It's all financed by debt. There's a massive inefficient state sector. The government are unable to push ahead with painful reforms. So we don't know when it's going to collapse, but it's going to collapse. And yet, for that entire 11 years, and as we push forward into the 2020s, China's growth continues, China's wealth continues to rise, China's international influence continues to expand. So my motivation when I put pen to paper to write my book, China, the Bubble That Never Pops, was to explain why. Why has the Western commentary, the Western view on China been too pessimistic? What have we missed? What are the hidden sources of strength in China that we should be paying more attention to? So today, what I'd like to do is talk through a few areas: debt, leadership, the state sector, and long-term growth prospects, where I think we don't get the China story wrong, but we get the emphasis in the wrong place, and we miss some of the important positives which continue to play out for China's economy. Before I wrap up, and very much look forward to conversation with Ambassador Caramuru and also all of you, I'll say a few words about the COVID shock and how that's been a kind of a stress test for the Chinese economy and for some of the ideas in my book. So first of all, let's talk about debt. So this chart shows you the debt to GDP ratio for China's economy. And this is really the primary window or the main lens which many Western economists have for looking into China. And what you can see is that in 2008, China's debt to GDP was low and stable at around 140%. But by the time we get to 2015, 2016, debt to GDP has risen all the way up to 260%. And if we look around the world and we scan the history books, we can't actually find any country which has taken on as much debt as China in as short a period of time as China. But we do find a number of countries: Korea ahead of the Asian financial crisis in 1997-98, the US ahead of the Lehman shock in 2008, Greece and other European countries ahead of the European sovereign debt crisis, that took on a lot of debt, less debt than China, but still had a financial crisis. And when we look at in a bit more detail at China's financial sector, on the borrower side, we see zombie state-owned enterprises. We see real estate developers building ghost towns in the desert. And we see local governments building roads to nowhere. And on the lender side, we see the rapid growth of shadow banks, sort of dodgy financial institutions who are growing faster than it's safe to do by dodging the regulations and expanding their loan book without enough capital to act as a buffer against losses. So there's lots to worry about. And when we put that picture together, we see an inevitable financial crisis. But that story actually is a partial story. That story misses something important about China's financial sector. To see why, let's think about where financial crises come from. So for a financial crisis to occur, problems on the loan side of the balance sheet, a buildup of bad loans, is a necessary condition, but it's not a sufficient condition. For a financial crisis to occur, you need problems on the asset side of banks' balance sheet, but what you really need is problems on the liability side of banks' balance sheets. Banks don't fall over just because they have bad loans. Banks fall over because they have bad loans and they run out of funding. Lehman Brothers in 2008 fell over because it had invested in dodgy mortgage-backed securities, but mainly it fell over because the investors who funded its operations decided to pull their money out, and it couldn't roll over its positions. Now, in China, there are a lot of problems on the asset side of banks' balance sheets. We talked about loans to state-owned enterprises, real estate developers, local governments, low-quality borrowers. On the liability side of banks' balance sheets, though, the situation looks much more stable. China has a very high savings rate. China has capital controls, which mean it's hard to take money offshore. And what that means is that China's banks have a very stable funding base. And what that means is that even as problems on the asset side of their balance sheet continue to grow, even as bad loans continue to increase, there's no trigger for a financial crisis to occur. So let's change gears a little and talk about China's leadership and China's leadership's capacity to execute on reforms. So here we have Hu Jintao, who was in charge of China when I arrived in 2007, and Xi Jinping, who was in charge when I left in 2018, and of course is still in charge today. Now, in the West, when we talk about Hu and Xi, we have a story about failed reform. When we talk about Hu Jintao, we talk about a committee man, a consensus-oriented leader. If we're being less charitable, a weak leader who couldn't get things done. When we talk about Xi Jinping, we acknowledge that he's a stronger leader, a more muscular leader, but we worry that he's captured by the state sector, doesn't see the benefits of the market. So for both leaders, we tell a story about failed or stalled reform. My view is that that story actually is not accurate. And when we focus on economic and financial reforms, both Hu Jintao and Xi Jinping have quite an impressive track record. So let me just give you one example from the realm of macroeconomic and financial policy. So the two most important instruments for control of the economy are the interest rate and the exchange rate. The interest rate sets the price of money. The exchange rate sets the price of foreign goods. Now, if we go back to 2003, 2004, at the time, the main Western criticism of China was that interest rate and exchange rate were both set by the government and held at an artificially low level. And that was thought to be a main source of inefficiency in China's economy. over the last 15 years, incrementally, cautiously, but in the end, rather comprehensively, Hu and then Xi have delivered on reform of the exchange rate and the interest rate. The yuan is now set by the market and substantially close to fair value. And on interest rates, the PBOC has moved much closer to a market-based system. So on the two most important instruments for control of the economy and the financial system, in the last 15 years, China's leaders have actually delivered a very comprehensive reform agenda. And I would add, they've delivered that agenda in the teeth of fierce opposition from vested interests. The entire export sector, the powerhouse coastal provinces of Guangdong and Zhejiang and Shandong, all opposed exchange rate liberalization because the stronger yuan made their businesses less competitive. But China's leaders did it anyway because they thought it was good for the overall efficiency of the economy. The entire state banking sector opposed interest rate liberalization, which threatens to erode their profit margins. But China's leaders did it anyway because they think it's good for the overall efficiency of the economy. So we tell a story about, we tell a story about leadership failure and reform failure and capture by vested interests. And basically, I think that story is wrong. And on economic and financial policy, China's leaders actually get quite a lot done. Let me give you one example of that in respect of the financial sector. So in 2016, China's leadership decided that there were too many risks in the financial sector. And in particular, they found that there were too many risks in shadow banking. And so Xi Jinping's chief economic advisor, Liu He, launched what was called the deleveraging agenda. And he empowered the People's Bank of China, China's central bank, to change the situation. And the People's Bank of China traveled around the country and they knocked on the door of all of the commercial banks and they said, show us your balance sheet. And if they didn't like what they saw on commercial banks' balance sheets, if they thought they were taking too many risks on their asset allocation or their funding, then they would impose meaningful punishments on the banks. I remember traveling around Henan province in 2017 and speaking to a number of local lenders, and the PBOC crackdown on shadow lending had a real impact. And you can see that captured in this chart. This chart shows you the growth of the shadow banking sector in China. Till 2016, it was growing extremely rapidly. In 2016, when Liu He launched that deleveraging campaign, growth in shadow banking slowed rapidly, and shadow lending actually contracted for 2 years in 2018 and 2019. So we underestimate China's leaders, we underestimate the capacity of China's leaders to deliver on painful reforms, and we also underestimate their capacity to get to grips with problems like risks in the financial sector before they blow up. So let's change gears again and talk a little bit about the state sector of the economy. Now, there's probably no area of economic life where the contrast between the US and China, or Western countries more broadly and China, is more sharply drawn than on the issue of state versus private ownership. In the US, the private sector and private ownership is seen as a main source of economic dynamism. In China, the state plays an enormous role in the economy. If China's state-owned enterprises were themselves a country, they would actually be the third biggest economy in the world. Only the US and Japan would be bigger. Now, in the West, we have a more or less entirely negative view of state ownership. We see state ownership as a huge source of inefficiency and a huge source of corruption. That's not an incorrect view. If we look at China and we look at the state sector, there is a lot of inefficiency and there is a lot of corruption. But inefficiency and corruption is not the only way of thinking about the role of state ownership in the economy, and it's not the way China's leaders think about it. So I just want to take a minute to try and understand how China's leaders think about the role of the state sector in the economy. And to do that, I want to go all the way back to 1990 and hear what Deng Xiaoping, China's great reformer, thought of Mikhail Gorbachev, the great reformer of the Soviet Union. So here's what Deng thought of Gorbachev. My father, Deng Xiaoping's son, said, thinks Gorbachev is an idiot. So why did Deng think that Gorbachev is an idiot? Well, I think one reason is because Gorbachev attempted to reform the Soviet economy by taking his hands off the levers which controlled the Soviet economy. He attempted reform through comprehensive liberalization. And when he did that, he lost control of the economy, ultimately lost control of the government, and the trajectory for the Soviet Union was not particularly positive. China's leaders have deliberately chosen a different path. The commanding heights of banking, industry, energy, communications all remain in state hands. And that does cause problems. That is a source of inefficiency, but it also brings opportunities. State ownership in China is an instrument of development. The government can direct state banks to finance the acquisition or development of new technologies. They can direct state firms to finance, organize the rollout of those technologies on enormous scale. And that playbook has proved extremely successful in lifting China up the development ladder, from production of toys and textiles in the 1980s and 90s, to steel and ships, to sustainable energy and high-speed trains, and in the future, perhaps to dominance of areas like AI, electric vehicles, and other key technologies for the 21st century economy. State ownership is also a tool which China's leaders can use to manage the ups and downs of the growth cycle. In a downturn, the private sector will turn cautious and it will shed workers and it will halt investment projects, and that can make the downturn worse. If you have a large state sector, as China does, then the state sector can be instructed to hold on to their workers, to accelerate investment projects. That's a tool which comes at which can be used only at the expense of some increase in inefficiency, but it's also a tool which China's leaders have demonstrated can be used effectively to smooth out the business cycle and prevent sharp downturns in growth. So the last area I wanted to touch on is China's long-term growth prospects. So when we think about China's long-term growth prospects, we tend to think about problems. We think about the shrinking working age population. We think about the middle income trap. We think about the potential for trade wars with the United States. And all of these things are real problems, and they will be a drag on China's growth going forwards. But when we focus on those negatives, we miss a couple of really important positives that China has had in place for the last 40 years, and I think will continue to have in place going forwards. And these positives are so big and so obvious that they were obvious even to Adam Smith, the grandfather of modern economics, when he wrote his famous book, The Wealth of Nations, all the way back in 1776. So let me share a couple of things which Adam Smith noticed back in the 18th century. I'll quote from the relevant section in his book. The great extent of the Empire of China, the vast multitude of its inhabitants, is of render the home market of that country of so great extent as to be alone sufficient to support very great manufactures and to admit of very considerable subdivisions of labor. So that's the first thing. China is so big that they can achieve enormous economies of scale. It's obvious, but it's important. Adam Smith's second point. By a more extensive navigation, the Chinese would naturally learn the art of using and constructing themselves all the different machines made use of in other countries, as well as the other improvements of art and industry which are practiced in all the different parts of the world. So Adam Smith was right on this as well. He was also 200 years too early. But in 1980, when Deng Xiaoping kicked open the door between China and the world, and even more in 2001, when China entered the World Trade Organization, you had these two very powerful drivers of growth working together. And you had China's enormous scale and the ability to achieve world-beating economies of scale for Chinese businesses, combined with engagement with the world, which allowed them to learn from, and in some cases steal from, foreign technology. When you put these things together, you had an enormously powerful driver of growth. The question then becomes, has that driver run out of steam? Are we at the end of China's development story? And my answer to that is no, for a very simple reason. China's GDP per capita is a third of the level in the United States, a third. And so what that means is that there's just very, very clearly enormous room for China to continue growing rapidly just by absorbing the leading foreign technologies from America, from Japan, from Germany and elsewhere, and diffusing them more broadly across China's economy. So let me try and pull the pieces together and just speak briefly about the COVID shock and what that tells us about China's economy, and then very much look forward to a conversation with Ambassador Caramuru. So COVID is of course primarily a human tragedy. It's also a stress test for economic and financial systems. Now, let's see what happened to China in the first quarter of the year as COVID hit. Well, this chart tells you the story. Business profit collapsed, household income collapsed, tax revenue collapsed, and GDP growth collapsed. Now, what happened to China's financial system? If China's financial system is really so fragile and everyone is losing money and can't repay their loans, surely China should have a financial crisis. Well, of course, that didn't happen. China didn't have a financial crisis. What happened to China's growth? Well, this chart tells the story. This chart shows you daily activity indicators that we've put together for China and other major economies. China is the dotted yellow line. And what you can see is that China fell, but didn't fall as far as other countries. And China recovered more quickly than most other countries. So COVID was a huge stress test for China and for the world. China seems to have come through that stress test quite well. Why is that? Well, I think it comes back to some of those sources of strength that I was talking about. Banks that are very well financed can afford to say to borrowers, don't worry about repaying the loan today or tomorrow or this week or next week. We know you're in a terrible shock because of COVID. You can repay us next quarter or next half or next year. A government which has a big state sector can say to its state-owned firms, don't let any workers go. In fact, hire some more workers and accelerate your investment projects to get the economy out of the slump. So we overstate the weaknesses in China's economy. We understate the strengths. Those strengths have been visible in the first half of 2020 through the COVID shock. That's why my book is called China, the Bubble That Never Pops. And that's why I anticipate China's growth will continue to slow, but remain pretty rapid in global comparison out over the next decade. So thank you very much. And now I'll close my presentation and hand back to the ambassador for discussion.
Well, thank you, Tom. This was an excellent presentation. Opens the appetite for your book. Just like you, I arrived in China in 2008, and I saw a portion of Hu Jintao period and then Xi Jinping's era. When I arrived in China, there was the general fear that the private sector would not be able to handle all the changes that the public sector was introducing in the economy. They had just approved labor contract law, and then the private sector was being asked to make social security contributions. And I remember one of my first contacts with the private sector, people were saying, "No, China is not prepared for that. They are thinking about a different country. We are not yet prepared for that." Actually, they were, because many changes were made in after the 2008 crisis, but these changes were not changed. And we saw China having deep changes. But then the economists, the Western economists, started to assess the Chinese economy every year and say, well, this economy either is going to go into very bad directions, or they will have to adopt fully the rules that we follow in the capitalist economies. One year, the problem was the inefficiency of the SOEs. The other year was the level of debt. The other years was the extended fiscal deficit that the IMF calculated at 10% of GDP. And then I heard all these and I read all these assessments every year, and I say, but this does not correspond to what I see in this reality. And I have to say that I have never seen anyone explaining why this happened and confirming this idea that despite the challenges and despite the difficulties, China was able to keep a good pace of growth and keep a certain level of logic, a high level of logic in economic management. And I appreciate your explanations for that. You gave them just now. The sources of strength of China are underestimated by many economists. The levels of creativity, the abundance of Chinese resources, even intellectual resources, the political scenario that helps very much, the capacity of China to learn with other countries' experiences. I would add two points to your points. First is the capacity of China to take risks. Both the public sector and the private sector in China, they take risks with an open heart, with an open chest. And the second point is this capacity of China to go through experiments. In the West, it's very difficult for a government to propose that, the economy was going to go through a certain experiment, you see. But in China, this is very common, and China accepts the positive and the negative experiments, and they are able to correct things. I remember that years and years ago, like 2010, 2011, I went to make a presentation to the International Financial Institute, the one that is based in Washington. And I made a presentation, quite positive presentation by China, and everybody said, but you didn't see the problem of the shadow banks. Shadow banking is a tragedy in China, and at some point in time, shadow banks are going to create unsurmountable problems to the managers in China. And actually, I saw what you described in your presentation. At some point in time, around 2018, 2019, the shadow banks started to be disciplined, and then they lose their force, just like the fintechs. China at some point in time had more than 700 fintechs. Then they were considerably reduced and all that. So like you, I am a believer in the capacity of China to deal with stress situations and to find solutions that are unknown to the West, but that work very well in their own reality. But there are a few phantoms in the Chinese reality. One of the phantoms, or the most important of one, is the one that you just talked about, the level of debt and its impact on the financial system. You see, from the beginning, we saw that from the opening up period of China, we saw that small levels of debt could produce very high levels of growth. But with time, we started to see that China needed high levels of debt to produce low levels of growth. And at some point in time, people ask themselves, and I do ask myself, is there a ceiling? Is there a limit to that? Where is it going to? When I talk to the Chinese authorities, to the Chinese people, not only the authorities, to different people in China, some of them say, yes, we have to be able to devise a strategy to that. And we'll have to be able to have a strategy and control the situation. You know, have a reasonable way out of this situation, and then solve the problems of the banks, particularly the local banks that have very high levels of debt, that carry, you know, of a bad portfolio. You know, the quality of the portfolio is quite poor. Sometimes, but others say, no. These levels of debt have to do with infrastructure investments. It's always good to invest in infrastructure, because if you don't see the results in the first run, in the long run, they always have a positive impact on the economy, and we will continue to invest in infrastructure. Well, only a country with the levels of savings that China has can give itself the opportunity to invest in infrastructure projects that in the short run do not have a real impact. And these people usually say, well, the problem of that, the economy itself can solve it, because we have very low levels of inflation. And at some point in time, we can produce inflation in the economy, and inflation by itself would help us to solve the question of that. So I see this phantom. I still believe that the Chinese economy carries this phantom, lingering in the air. And I don't know whether there's a ceiling, and I don't know whether there's a solution. There is a new phantom that came with the Xi Jinping period, which is, after all, what's the role of the private sector, isn't it? Because in the Hu Jintao period, we saw a strong encouragement to the private sector in China. And after Xi Jinping started his period in China, we saw the SOEs, gaining strength in the Chinese reality, and many questions about, but after all, what's going to be the role of the private sector? What should we do? And I see many entrepreneurs saying, yes, it's easy to get a loan if you are an SOE, but if you have a private company, it's very difficult to get a loan. My sense is that in the minds of the government, strategic sectors will be in the hands of the SOEs, while creative sectors are going to be led by private sector economists. And at some point in time, there will be a dialogue between the private sector and the public sector. And this dialogue is going to produce something positive for the country. Actually, today, there's a lot of attention internationally to what kind of dialogue is this one, and what kind of impact this dialogue has on the independent management of private sector companies in Brazil. So I see these big phantoms lingering in the air. Do you agree with me? Do you see any other phantoms lingering in the air?
Yeah, I think those are some great points. I have to admit, I'm slightly torn. On the one hand, I'm delighted to find someone who agrees with me so wholeheartedly. On the other hand, I worry that it's going to be a problem for the quality of the dialogue if we just just agree with each other on everything. So I'll just pick up on one of the points you made about innovation and risk taking, and then address briefly the points on debt and the private sector. I remember back in the 2012 US presidential election, which you recall was between Obama and Mitt Romney, a big issue in the campaign and a big talking point for the Republicans was a company called Solyndra. And Solyndra was a high-tech company, and it had received a government grant to support its kind of innovative technology, and it had failed. And the Republicans and Mitt Romney were hammering Obama with this. This was a failed investment. This is why the government shouldn't be involved in the economy, right? And in my view, that's actually entirely the wrong view to take, right? The reason why government should be involved in funding research and development and innovation is because those activities are by definition risky and have a high failure rate, right? So what you need is a government which is willing to fail at nine projects, because the 10th project will succeed and will generate a game-changing innovation, right? And in the US and in other Western countries, we've just become really bad at that, right? We've got no tolerance for failure by the government, even when failure is part of a larger process of success. And in China, I don't want to sound Pollyanna-ish about China. I know they get some really serious things wrong, but one thing they get right is that willingness to take risks and experiment and accept failure as part of a process which ultimately leads to success and innovation and development. So on your two phantoms, I think that's a great way of putting it, a kind of phantoms kind of haunting the Chinese economy. So debt, I mean, yeah, clearly debt is a huge issue for the reasons which I discussed, the strong financing, the strong funding base for the banks. I don't see a crisis. I don't see a kind of a Lehman shock, but it's certainly possible that as debt mounts and the cost of repayment increases, we have something which looks like a kind of Japanification of the Chinese economy, right? You don't see a moment of collapse, but things just kind of grind lower. That's certainly a possibility. On the relationship between the private sector and the state sector, I certainly see the problems that you've identified. I tend to take a slightly more optimistic view. And the reason for that is when I think about the areas of the economy where the state is dominant, so heavy industry, for example, steel and cement and construction, these are parts of the old economy, right? No one thinks that Baosteel or PetroChina are China's future, right? These are China's past. When I think about the companies which will shape China's future, Alibaba, Tencent, Meituan, these are private companies. Yes, the Communist Party and the government has more kind of influence over them than the US does over a Facebook or an Amazon, but they're not setting strategy for these companies. These are privately run and privately operated companies setting strategy based on commercial terms. So I certainly see that tension between the state and the private sector. It's certainly something to keep an eye on. But because the companies which will shape China's future are almost 100% sort of private companies, that makes me a little bit more optimistic.
I tend to agree with you. Well, let me make a different provocation. You say something in your book that is very interesting. You say that Nixon opened up China and the Chinese economy, and Trump is trying to close it down. Hard to disagree with you. But when I talk to many people in China, I see a general support to the government and a negative view about the pressure that is made by Trump on the Chinese government and on the Chinese economy in general. But I also see many people saying that, well, the United States helps China to reform and open up, isn't it? If we did not have the pressure of the United States, it would be more difficult to open up, or the incentives to open up, but the economy would not be there as they exist today. You see, I think in a certain way to agree with them. However, we have to admit that at this point in time, Trump exceeded any expectation of pressure that a country can put on another country. And this is not helping anymore, but it's disturbing the possibility of China opening up. China keeps saying that they are going to open up. And I think that's a good response to the pressures. But China has been saying that they are going to open up in certain areas, the financial area, for example, the capital account, for example, and nothing, things have worked very slowly, very slowly. Just like you, I believe that the factors that will change the Chinese economy are structural factors. You mentioned in your book many times, and you just mentioned in your presentation, the aging of the population and its impact on the working force, you see. And I see that there are some other structural factors on the long run that will change the economy. One of them is consumption, the role of consumption. If consumption is going to increase as expected in the Chinese economy, the savings are going to be reduced considerably, isn't it? And then this will have a big impact on the bank, the structure of banks, on the the functioning of the financial markets and all that. So I look at these main factors, and I see that these strong, deep structural changes are the ones that are going to promote changes in the Chinese economy. I don't believe that short-term crisis will have an impact that is going to be significant in terms of changing the whole reality. However, I think the uncertainties that were created by Trump are quite strong, are quite big. And the uncertainties about the future are bigger now than they used to be in the past. So I would like to listen to your views on the short-term future and the long-term future. Do you believe that this pressure in the short term has the potential to make big changes in the reality? And in the long run, how do you see China? You see China as an open economy, or you see China more and more closing down and getting, immersed in its own problems and realities, with consumption dominating growth, and less and less China being connected to the international reality? How do you see the short run and the long run?
That's a great question. And I think one of the mistakes which people make here in Washington, D.C., is they think that the relationship, there's only one actor in the relationship between China and the United States, and it's the United States, right? The United States decides we will be friends with China or we will not be friends with China. And China doesn't have any kind of agency or capacity to make decisions about that. And in fact, the reality is that there's a debate taking place in Washington, D.C. There's also a debate taking place in Beijing, right? And in D.C., clearly the mood is shifted very, very strongly away from engagement with China. In Beijing, the mood has shifted away from engagement with the United States and indeed engagement with the world. In China, they now talk a lot about the risks that come from their engagement with the global economy. They talk about their supply chain vulnerabilities. They talk about the vulnerabilities they have from participating in global telecom systems. They talk about the vulnerabilities they have from participating in global financial networks where the US plays such a large role. So the US is making a decision, and we'll see what happens in the November election. I think a Biden presidency could look quite different in terms of the way it engages with China. China's also making a decision. And if you listen to what Xi Jinping is saying these days, he's talking a lot about reducing those vulnerabilities, making sure that they can produce everything they need at home, reducing their exposure from participation, broadly speaking, in the global economy and financial system. So where's that going to take us? I don't know. I suspect we are not going to return to a path of kind of unfettered globalization. I think the combination of the trade war and the COVID shock has driven everyone to think about some of the kind of larger national security implications of outsourcing such a large part of the things that we rely on. I suspect that this is going to have some consequences for China. You mentioned China's shrinking working age population. So if you have a shrinking working age population, where does growth come from? Well, growth comes from getting more efficient, getting more productive. And how do you get more efficient and more productive? Well, if you're a catching up country like China, that mainly happens by borrowing or stealing foreign technology. Of course, that's one of the main issues in the current US-China trade conflict, the concern about China stealing or forcing transfer of intellectual property. So if the door between China and the world starts to close, that door which Nixon opened, if Trump manages to push that closed and Biden continues to push it closed, that also closes the door to technology transfer. And that means that China's future productivity growth would be weaker, and that problem of paying down all of the debt that they have would be a little bit harder.
Very good. Let's go to the audience questions. The first question has to do with the WTO. The question is, some people argue that the West has allowed China not to play entirely by the world's trade rules. But now this attitude is clearly changing. What, in your views, would be the impact on China?
Yeah, so that's a great question. I mean, one of the strange things about the last 3 years is that in 2018 and 2019, we thought that the trade conflict, the trade war between China and the United States was a low point in China-US relations. In the light of what's happened in 2020, we actually now see that the trade war was the thing holding US-China relations together. Yes, increasing tariffs, increased tensions, but the underlying objective of USTR Lighthizer and President Trump was actually solving specific problems like IP theft and market access so that the relationship could continue on a sustainable basis, right? If we listen to the speeches which have recently been made by US Secretary of State Pompeo, Attorney General William Barr, and others, they actually paint a much darker relationship, a much darker picture of the US-China relationship. It's kind of a Cold War picture where Pompeo and others are kind of presenting China as a kind of an evil empire, which the US has to struggle against. So it's strange to say, but actually, I think the world, the US and China actually should hope that they can get back to just having a trade war. Because if the vision painted by Pompeo and others comes true, then I think the future has potentially a much more serious conflict.
Very good. The other question is the following. What are your expectations for Chinese investments in the world, considering the new normal imposed by the COVID-19 pandemic?
Yeah, so that's a great question. So I think China made a public relations mistake. China announced its arrival on the world stage too early. The Belt and Road Scheme, the China 2025 scheme, even things like winning so many gold medals at the Olympics. These were just kind of really high visibility announcements that China was here, and China had its own view on how to do things, right? They weren't planning to adapt to the Western democratic capitalist model. And I think that was a scary moment for America, and to a lesser extent for Europe. And that actually explains why we have Donald Trump and trade wars and all of this new conflict. So what we've seen is China sort of doing a PR shift, right? So they're not really talking about the Belt and Road anymore so much. They're not talking about China 2025 so much. I expect they'll still win lots of gold medals at the Olympics, but that's a different thing. But so they're not talking about it, but I think they're still doing it, right? And I think COVID-19 is going to put the world into a very, very deep hole, especially developing and emerging market economies, which do not have enough money to pay for stimulus. And they're not getting the money they need from the G20 or the IMF or the World Bank. So I think once we get through this COVID-19 shock, there's going to be an additional demand for investment in parts of Latin America, parts of Central Europe,
no doubt,
South Asia, and China's going to be there with the money.
Yeah, I agree fully with you on that. Although I think that the greatest need of money is going to be money to finance budgets, to finance the fiscal policies. And I don't think that China has the experience to do this. The IMF has, the development banks have, but China doesn't have the experience to do that. First of all, it's quite risky. Second, there's no Chinese company involved. So there is a natural disincentive for China to participate in this kind of financial. And the third point is that this kind of financial is usually a combination of forces. It results from a combination of forces, multilateral institutions and bilateral donors or bilateral supporters. And China doesn't have really this capacity to work in cooperation with multilateral institutions in the international reality. I think there's a lesson for China on this aspect. China will have to learn something about that. But of course, China will be prepared to finance infrastructure investments and other investments that have to do with their own companies participate. I must say that when the crisis started, I thought that China would follow the pattern of the 2008 crisis. In 2008, China went abroad shopping. You see a lot of investment. That's when China really increased its investments in international reality. And at this point in time, what I see China doing is China is concentrating it in its own reality, isn't it? Even what you hear from the highest authorities in China is, let's focus on our internal reality. Let's solve our internal problems and not to go out at this point. First, because the risks are very high. The world is very unstable and we don't know what's going on there. Secondly, because of the geopolitical forces, isn't it? China is more cautious about the geopolitical environment China will have to face abroad. Do you agree with that?
Yeah, I think that's right. I think it's in a sense, this is a moment of opportunity for China, right? The rest of the world is in confusion and in recession and unable to organize. And so this is a kind of a moment when a rising power can do some more. At the same time, as you say, it's also a moment of huge uncertainty, particularly in relation to the United States, right? So I think that's why we've seen China kind of, and you'd know more about this than me from a diplomatic perspective, but I think what we're seeing is China underreacting to the United States, right? The yes, United States is kind of whacking China repeatedly with a big stick, and China's kind of like saying no, 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 but they're not whacking the United States back, really, right? And I think the reason for that
they are saying they are opening up. But go ahead. The reason is?
I think the reason is they're waiting for November, right? And because what they want is a basis for restoration of constructive relations under a Biden presidency, if Biden gets elected. So I think November and what follows is actually going to be rather important for China, the US, and the world. If it's a Trump win and we carry on the existing trajectory, I think we're going to see China reacting more forcefully. If it's a Biden win, I think potentially we'll see what position the Biden administration adopts. I don't think we're going back to the kind of very friendly relations of the Obama era, but I do think there's a basis for more stable and constructive relationship potentially.
Well, the next question is asked by someone who seems to disagree fully with you and me, because the question is the following. Suppose the bubble finally pops. What will be the consequences for the West and for Brazil in particular?
So good. I'm glad someone disagreed. We should find out who this person is and invite them to be on the panel for the next next presentation. So it's a great question, and it's actually I devote a chapter in the book to exploring a scenario where the bubble bursts and thinking about who suffers most. Basically, I put the I break the world into three groups. You have your Asian neighbors, so Korea, for example. Now, for Korea, they export a lot to China, selling to Chinese consumers, and their electronics products are shipped to China for assembly before being shipped to the US, Europe, Brazil, and elsewhere. So the Asian neighbors, Korea, Japan, Malaysia, the Philippines, they suffer a huge blow because they take a direct hit from their own exports, and they take a hit as China's kind of role as the central node in the global electronics manufacturing supply chain breaks down. Then you have a second set of countries, and here's where Brazil comes in. So you have Australia, Brazil, Chile, who are big commodity exporters to China. So they take a big blow just because commodity exporting is a big part of their economy. China is the main driver of global demand. So if China collapses, all of that commodity demand goes away. And countries like Brazil and Australia take a big hit. Then you've got countries like the US, Germany, the UK. So they're further away, so they export less to China. They don't have very strong financial links. China's financial system, this is a source of stability, and also a reason a crisis would be relatively contained, doesn't have many links to the rest of the world. And countries like the US and UK would actually benefit if a collapse in China pulled down commodity prices. Oil would get cheaper, for example. So that's how I think about it. You've got your Asian neighbors, huge hit, your commodity exporters, including Brazil, medium-sized hit, and then you've got your US, UK, European Union, relatively small hit.
Well, a very interesting question about technology. Do you think there's really a trade war between China and the United States, or a technology war? And is it possible for the United States to contain the dominance China is achieving in technology?
Yeah, it's a great question. So I think the short answer is it's both, right? In 2018 and 19, it looked more like a trade war, but there was already the technology aspect to it with the embargo against ZTE and Huawei, the two big Chinese telecom equipment companies. Now in 2020, where we have the sanctions against TikTok and WeChat, it's very clear that it's a technology war and a trade war. Now, why is the technology part of it important? Well, a couple of reasons. Firstly, there's national security fears, right? We've seen how even a US company like Facebook can have a big impact on US elections, right? And not a very helpful impact on US elections. So naturally, there's a concern in the United States that if a Chinese social media company has a big presence in America, that's not very helpful. And then the second reason is, of course, that technology is a sort of fundamental determinant of economic success, right? If you own the technology of the future, you own the economy of the future. And things like TikTok, which are a video sharing app, doesn't seem like it's going to control the tech. It doesn't seem that important, but actually it is, because it's a way of collecting a huge amount of data, which can feed the development of AI, and AI is very important for the future. So it's a trade war, it's a technology war. The technology war is important for national security, important for economic development. Could the US conceivably contain China in terms of its technology development? I would say not on their current strategy, right? The US has some of the best scientists and the best universities and the most innovative companies in the world. It doesn't have all of them, right? There are innovative companies, there are good researchers in Brazil, in Germany, in Japan, in Korea. If the US does this on its own, it's kind of really just shooting itself in the foot. To be effective at something like this, you need a coalition, right? You need a coalition. And then the second point I would make is China today looks very different to China 20 years ago, right? China's domestic innovation capacity is much stronger than it was. If you look at things like the most cited AI paper in an academic journal, it's a paper by Chinese researchers, right? So China's domestic innovation capacity is much stronger. And that means that if the US says, no, we're not going to play with you anymore, that's a problem for China, but they have some other resources they can draw on.
Well, the very last question is about decision-making in China. I was going to ask a question in that direction, but someone in the audience also asked the question. I'll combine my own question with this person's question. My question is, I've been in China for many, many years, and I think it's very difficult to understand how the decision-making process works in China. How do they build these creative ideas that we know that they always have? How do they build the necessary consensus to innovate in economics? Because they have been innovating in economics in many, many areas. And I think it's very difficult to understand that. And my question to you is, after so many years in China, do you think you understood it? Can you describe your understanding if you did? But the audience's point about decision-making is the following. How do you think the Chinese decision makers, I don't know who they are, if it's the government, it's the party, whether it's a combination of those, but how do you think that they combine domestic and external risks in their matrix?
That's a good question. Okay, so maybe I'll say a few things. I'm not sure I'm going to get to a perfect answer on either of those things. So the first thing is, when you read about China in the press, you kind of have the sense that the people who run China are kind of like evil geniuses who are kind of plotting in sinister ways behind the scenes, right? And then, and even me sitting in Beijing, that seeped into my brain, and that was the kind of, I guess, my kind of view. And then from time to time, I would go into the PBOC, the central bank, or the NDRC, the Government Economic Planning Bureau, or the National Bureau of Statistics, and I'd meet with them, and I'd be like, you're like pleasant, regular, smart people trying to make the best decisions you can for the future of China, right? And I always find that extremely refreshing and a kind of a useful corrective to the kind of the tone that you see kind of pervading sort of kind of commentary on China. I'm not sure. I'm sure you had the same experience, Ambassador.
Sure.
And then the second thing I would say is, so China's not a liberal democracy, right? There is not freedom of speech, right? You cannot criticize China's senior leaders on your WeChat group or publish an article which is kind of directly critical of them. But that does not mean that there is no debate and there's no discussion on policy, right? So there is an active debate on the right economic policy for China. There's an active debate on where monetary policy should be. China is the world's biggest consumer of advice from the International Monetary Fund. So on the question of who should run China, no, there isn't any debate on. You're not allowed to have a debate about that. On the question of what's the right balance between the state and the private sector, what's the next step on interest rate liberalization, there is a lively debate inside China and a willingness to listen to outside voices. So I think that's important. On the question of how to think about the balance between domestic and external risks, I don't actually know how they aggregate those things up, but I can say that I'm pretty certain that in the last few years, the balance of those discussions has tilted away from domestic towards international.
Yeah, I agree with you. Well, I think we've reached the end of our debate. It was a very pleasant debate for me, a very interesting debate according to the audience, because we have been receiving many compliments. And I do appreciate your views and your comments as much as I appreciate your book, as I said at the beginning of our debate. Do you have any final comments to make?
So I want to alert the audience to an imbalance, a serious problem in the publishing world. So there was a book published 20 years ago by a man called Gordon Chang called "The Coming Collapse of China," and it predicted an imminent collapse of the Chinese economy, and it was wrong when it was written, and it's still wrong today. But if you look at the Amazon rankings, it's more or less in line with my book, which is, I think we would all agree, a horrific imbalance in the publishing world. So we can't solve all of the problems in the world. We can't solve the problem of COVID. We can't solve the problem of the US-China trade war. But working together, I think we can solve that imbalance in the publishing world. So I'd encourage all of you to go and buy my book, China, the Bubble That Never Pops. And I'd also like to very much thank you, Ambassador, and the CEBC for hosting the event. It's been a great discussion, and I look forward to more in the future. Well,
I strongly support your encouragement. Thank you very much. Thank you all. Thank you, CEBC. Up to the next debate. Thank you very much. Bye-bye.